it's a big boys game.
Yeah.
Right? You know, so if you're going to put up 10% hard, like the very first deal we did there, you got to know what you're doing. The real secret to real estate is the tax advantage. I'm always looking for a deal that we can buy, and in 2 years later, we can refinance it so that we can go buy something else.
The Federal Reserve delivering a 1/4 percentage point rate cut.
If it's a really good investment, you'll raise the money. If it's not a really good investment, then you've got a bigger problem because now they're not going to do well.
And you only have one reputation. Welcome to No Vacancy, where I share conversations with LA's top multifamily owners, investors, and visionaries. I'm your host, Taylor Avakian, the founder of the Group CRE, and I specialize in the sale of apartment buildings in Los Angeles. On this show, we cut straight to what matters, market insights and real-world strategies straight from LA's multifamily icons to help you navigate one of the most complex real estate markets in the world, Southern California. Enjoy. Welcome to No Vacancy with me, Taylor Avakian. Today's guest is a great friend and very happy to have him in here, Kyle Ransford. He's the principal and CEO of Cardinal Investments, multifamily investors, principals, syndicators in Southern California. And I'm very blessed and happy to have him on the show today because I have been nagging him to get on here, and he was very kind enough. He drove hours and hours away and might have had a drink last night. So he's bear with us today, but we're gonna have some fun.
We'll get
Kyle,
to it.
Thank you very much for being here, man. I
Yeah,
appreciate
thanks for
it.
having me.
Of course. So want to kick it off with really kind of the journey. I want to start at the beginning. We talked about this before, and I didn't know this about you, but you started real estate in the 90s, and then, fast forward a couple of years, started a couple other entrepreneurial ventures. Give me the entry point into real estate and how that started for you.
Well, the first real estate I did was straight out of college. I bought a duplex on 55th Street from the RTC, cashed advanced my credit cards for $80,000 and bought a duplex, fixed it up. And back then you could fix up a whole duplex for like 20 grand.
Oh my God. How much was the property?
So we bought it was like 82,000. We fixed it up for like 22.
Okay.
And we sold it for 135 FHA.
Wow.
And we were sort of off to the races for a while. Yeah.
Did you have buddies that you guys said to yourself, we want to invest in real estate, or how did the interest in real estate become?
Somehow I'd always had like an interesting thing about real estate. I kind of like the math and the finance and that kind of thing. And I had a cool real estate finance class in college, but, originally, I was going to go be a loan broker, so I had this guy that I really liked. I was like in December, he's like, "Yeah, when you graduate, come work for me." I'm like, "Okay, great." And I call him like I graduate. I'm like, "Yeah, what's the story?" He's like, "Oh, it's a terrible time in the business. There's no loans. Don't do this." So I was like, "Well, but dude, you told me in December to do this. I'm planning on doing this. What am I going to do now?" Anyways, he hooked me up with some guy that was flipping houses basically, and so I put together a few deals. I put like 4 or 5 deals together for him, and then I was like, "What?" Then I started to realize like, "Oh, wait a second. You give me is commission. You don't give me any salary. If I find something for you to buy," and I found 4 things and I made $3,000 in commission that you didn't pay, the seller paid that. So I'm just really representing you as a buyer, and you made $100,000 on each of those deals. And I was like, can you scratch me like a little salary, like $2,000 a month to go with this? And he's like, I don't really want to do that. And so I was kind of like, all right, well, sometimes the best thing in life is to get pushed to go do something. So
Yeah.
I was like, all right. And
Started your own thing. Did you partner up with people, or did you go and do like on your own? How did that start at the beginning?
Yeah, no. So I did that one on my own, but quickly I was like, okay, well, I've cash advanced my credit cards. I can't buy another one. What am I going to do? Right. And then I had an accountant partner who had some money himself and some clients' monies that we did some stuff together. And there were some learning lessons in that as a 23-year-old. Every deal we did, like suddenly he wanted more every time we did the deal. I'm like, wait, didn't we make a lot of money on the last one? Why do you get more? Wouldn't we just have the same deal, right? So again, then that kind of pushed me to kind of go back my own way. So you have various pieces in life that teach you some lessons along the way.
And so that was in the 90s, and you did that for how many years?
So that was 94. And the RTC market was, pretty incredible. You still hear people talk about it today, old timers talking about it today. And by 97, I was a little bored, so I decided that I was going to go to business school. So I did business school at SC, kind of with the idea of, kind of flipping and rehabbing small companies. Then I left. When I got out of SC, the internet thing was happening, so I did some stuff in the internet space for a hot minute.
Like what?
So I first went to work at Houlihan, and did investment banking for about a year and a half. And then when the internet thing was exploding in '99, I had met a partner at Houlihan that had a big family office, one of the big 50 families of Korea. We formed a internet investment company in Korea. I raised $15 million from Microsoft, and we took it public in Korea. So it was a big wild ride.
Holy
I didn't
shit.
make any money out of it, but it was a big fun wild ride for a couple of years until the internet kind of went sideways in the early 90s.
Yeah, that 2000 bubble.
Yeah. So
Shit.
so it's kind of fun to play that for a bit. And then about 2003 is when the first investments that eventually became Cardinal Investments started to happen.
Wow. And at that point, this was still you, or you had partnered with that guy at Houlihan or had made a network enough where you could raise funds? Like this was a syndication, yeah?
Yeah. So, another kind of, young opportunity finds you kind of situation is like, so, when I was in my 20s and we bought some real estate, we were doing, you'd have all these friends that come up to you that, yeah, I want to buy I want to own some real estate and just make $5,000 a month for doing nothing. And I'm like, well, it's not quite doing nothing, but it is pretty cool that you make some money. And I, still had some assets so that we had originally bought in the first go around that I hung on to. And, but so all these guys is, yeah, let me get you a beer and let's talk about it and let's do this. And let's do this, man. Why don't you do that and me be a partner?
Yeah.
And so I always had a speech to those people. I'm like, yeah, I'd love to do a deal with you. You sound awesome. Go do these 5 things to go look for properties. Back then it was a little different than your world today, but stuff was, it was the early days of internet databases. So if you knew how to go online, that was a big thing to go online, and a fax machine was high tech. Go online, search for this, here's properties, multiples, market rents versus existing rents. And none of those people would ever call back, right? Because they didn't actually want to do it. And
totally.
Then, a good friend, Christian, or a younger brother of a good friend of mine, Christian Hager, I gave that speech to, and he went and looked online. He says, "Yeah, well, hey, what do you think about this?" And it was a boarded up fourplex in Highland Park for $151,000.
Oh my gosh.
That we still have that one. We still have that one today. I think the building now makes $150,000 a year, right? But
Jesus.
So it's 4 little bungalow, 2 bedrooms. I was like, yeah, actually, this is a pretty good deal. But now we need some money. I didn't really know enough. I'd done a couple hard money things with the original partner. I was putting stuff together, but didn't really know someone that was going to write me a hard money check. And so he knew someone, and his family kind of put up some of the original money. So his mom's a small partner in Cardinal today, and then so Christian and I went at it together for 5 years or so, and we got up to 10, 15 properties. I think there's still about 100 units that I'm partners with Christian on, and Christian kind of retired pretty quickly and early. It says, hey, I got my scratch coming in. And I've ever since been taking that and parlaying that and buying something, and Christian's been living it a little simple, but pretty peaceful. So
man,
there's lots of ways to do it.
So, and I wanted to talk to you about this because the first time that I met you, I went on LinkedIn, clearly, as any good broker does, and looks you up. And I had noticed on there, and this was 2018 or 2019, something like that. So I noticed on there that you had started other companies, one of them being Chef and one of them being a bank. Can you dive in a little bit to how you started a bank and then you started a food delivery service as well? What was how did that happen?
Yeah. Well, lots of real estate people as real estate people, you're always trying to go to borrow from the banks, and you're like, dude, why do they not get it? And I know how to do this because I know how to make loans. Banking is really about getting deposits, not making loans. But and I had a mentor friend that had started a bank and sold it 10 years later and done pretty well. So I talked to him occasionally. I have lunch with him kind of once a year. I was like, oh, this is kind of interesting. And, I had this vision that if you could be buying real estate, but also making loans against it, you could see lots of stuff. Oh, this one I'll make a loan against, this one I'll buy, that you just become more powerful kind of in the neighborhood and the network, which was really true. And so from that, I just started down the path of starting a bank.
Wow. Okay. So when you start a bank, what goes into that? That seems cool and amazing, and I think anyone would love to start a bank. But that's like, how the fuck do you start a bank?
Yeah, it's kind of funny. Like everyone's that's their reaction. How would you do that? Like what? So I was like, all right, well, I'm just gonna have one meeting a week about this bank thing. Like I'm doing my real estate thing. I'll start having one meeting a week. You talk to someone, it's like, yeah, it takes like 2 years to start a bank. I'm like, okay, well that's fine. I'm doing all this other stuff. Why does it take 2 years? Oh, well, you got to get, 8 board members, you got to get money, and then you got to file a regulatory thing and get approved. You're like, oh, that kind of sounds like a lot. So, yeah, there's this company, a carpenter company, like that's all they do is they help you start a bank. It's like, oh, okay, well, let me have a meeting with them. So go have a meeting with them. They're like, yeah, okay, well, that's kind of interesting, and, but you got to be able to raise some money. And I'm like, yeah, we've been doing pretty well in real estate for a bunch of people. Like, I think we've got a good network from all the syndications we've been doing that we could pull it together. And, they're consultants, so they just want to get paid, right?
Yeah, of course.
In the end of the day, you kind of think, as you get older, you think these things through a little bit more. So, I was having my meeting, and I was like, okay, you got to find a CEO. And I'm like, okay. So I had a couple meetings. I talked to somebody's like, oh, I have this friend that's at this bank, and maybe he'd do it. So I had a meeting with him. It's like, no. And then I had a meeting with somebody else. Like, yeah, I'd be interested. And you're like, oh, okay, well, now I kind of have a CEO guy, and I've got this other piece. But there was a defining moment when it was like, okay, we've had enough meetings, and we've given you enough free advice. If you really want to do this, it's $25,000 for the deposit to Carpenter and Company to help you start this bank. And so, I always kind of joke with people. It's like it's fun to talk about the businesses and, oh, I might do this and I might do this. As soon as you write a check, now it's real, right?
Real shit.
So now it's like, ooh, fuck, we wrote this $25,000 check. Now we really got to go. And so, there's I don't know. There's tons of stories around starting the bank, but effectively that's what we did. We raised $20 million. We started Bank of Manhattan in 2007, and I was executive chairman for about 5 years before I sold my piece to the private equity group, and they rolled up a bunch of banks, which is kind of the game plan in banking.
Jesus, that's fucking cool, really incredible, and I loved hearing that and knowing that. Okay, and then what about Cheft? Because that seems like a whole, complete 180. You say, hey, I'm gonna start a bank, and then now I'm gonna start a food delivery service. Like, what was that? Was that through a connection? What was that?
Yeah, I don't know. I've always done real estate. I've always had the real estate company. The real estate company is always a job shop, though. Every deal you get is kind of you work on that, and it has its nuances, and then you get another one, you work on that. It's a little harder versus like a business where you're producing a widget, and certain people do marketing, certain people do production, and then you can put more through to it because each new deal is a little bit different and takes a little bit of management over.
It's a shorter time frame too to get more money in the system. Real estate, it typically has longer times for you to actually get the returns or see cash from it, right?
Yeah, totally. So there's a bunch of nuances about the real estate business that, as a entrepreneur thinking person, you get from time to time I get bored in the real estate business, basically. So I've kind of go make a bunch of money in the real estate business, and after 5 years get kind of bored, and then kind of get excited about doing something else. So the bank was the first one. Then we went back to real estate. Did really well, and then also kind of was bored and thinking of something else. Somebody came to me and said that I'd worked with on another project, said, hey, I want to start a company. I said, it's funny because I love to cook, so and was exploring cooking and stuff like that. And then that was Blue Apron was the first person in that space, and I happened to see that, and they raised like $2 million at a 10. 4 months later, they raised $5 million at a 30, and then they raised like $10 million at a 75. And I'm like, in like 9 months, this company's worth like $100 million. I'm like, well, that's interesting.
Yeah.
And then I was with this buddy's one of my partners is Chris Granny out in the Hamptons, and at his house is this box from Blue Apron. I'm like, holy shit, I've been thinking about this thing, and what is this? And dug into it, and at the same time, this guy that had come to me said, hey, I want to start this thing. I said, well, go research all this stuff, because I'm doing this other stuff.
Real estate stuff and banking.
I had just gotten divorced too, so I was kind of taking a year off and messing around and flying around and partying, and so I'm like, yeah, go research all this stuff. And so he did, and came back. I'm like, well, that's kind of interesting, and talked to Chris about it. He's like, yeah, let's go for a run in this. The food delivery space, grocery is a giant industry,
massive. So
you're playing for a lot of zeros. He had an exit in one of his companies. He had been on my bank board too, and said, hey, this is kind of shake of the dice, but the numbers here are crazy, so we're going to kind of play for the jet and go see how it goes. So we had a really good time with it. That space kind of didn't end in the the way that we'd all hope. So there was no great exit to it.
Yeah.
It was 5 years of fun. We went from like 0 to 500 employees in 3 years.
Oh my gosh.
$80 million in revenue in 2 years. And so from like a building stuff and like being an entrepreneur, like it was fun, crazy days because you were always trying to solve new things and so forth. So it was a good time. I paid for it. But,
but the lessons hopefully learned and the connections and I mean that experience, right? You can take that into whatever you do next. Which I mean, is AI next for you, Kyle?
No.
You have the itch now, man.
I don't know. Like the tech stuff is funny because I laugh at like when I first got into real estate, I had this giant technology advantage because I was 22. And I bought a gateway computer for $2,000 on my credit card, and it had a 24-bit modem that would go when you dialed up.
Oh,
but you could go find out what was for sale online that nobody else could do because they weren't 22 and understood the computer. And so you could find out that all the listings got posted in the MLS, and the book didn't come out for 15 days. So if you looked online, you could see what was for sale for 15 days before anybody else knew what was for sale. So, I mean, imagine in today's world, like if you could be the first guy there and nobody else even knows, it would take 1 minute to download one like super grainy image. And if you wanted it in color, it was 15 minutes to download like a 3x3 thing. And then you'd print an offer and you'd fax it because that was a brand new technology too. And agents would get a fax and they'd be like, who is this that you're faxing me an offer and I don't know who you are? You don't have the courtesy to drive your offer over to me today? And you're like, well, I'm making 15 of these offers today on all these properties that I saw. And, you know.
Yeah, right.
Like, so we had this huge technology lead, but that was like the technology advantage that like today's laughable, right?
That's crazy.
But, you know, AI, we look a little bit about it and trying to figure out how we can put it in some places in our business, but you know, no one accuses me of being young anymore, so it's a little hard to get there.
It's definitely fascinating. It's, you know, me, I guess, being in the 20s, I'm very interested in the space,
as you should be,
and trying to leverage it to do better in what we do. Because the competitive advantage seems to be very small in today's market. Besides relationships, which it feels like in a lot of businesses, entrepreneurship, relationships drive the world. So. Speaking of relationships and syndication, you've had a lot of investors over the years.
Yeah.
You've seen from 22 when you worked at Houlihan and you were raising $15 million for this fund. How do you go about meeting people, building relationships, and raising capital, not only to invest in real estate, but in general for an entrepreneur?
It's kind of different. It changes over time. It's also funny. I found it like much easier to approach people and raise capital when you're younger. As you get older, it gets it's a little more awkward to meet people and raise money in certain ways in the high net worth space. But you know, it's about relationships, and you know, if you do a good job for people, that word travels, and it's still the absolute best way to do it. Like another, you know, technology going back a bit, we were the very first people to use this thing called GoToMeeting, which allowed you to do a conference call of 80 people before, like, the only way to raise money for a syndication was to like go have coffee with somebody and say, hey, you know, will you give me 25 grand? And it's like, if you're raising $5 million, 25 grand at a time, it's too many coffees. You can't do it. Right. So GoToMeeting, we were the original, one of the, like, what do you call it? Early test people.
No way.
And the big thing was you could put the presentation up and you could control the screen that everyone was looking at, right? Sounds like, oh my God. Sounds like, you know, but it literally took 20 years before that technology became ubiquitous, called Zoom, right? Like,
wow. They were 20 years early.
Years later, right? So we had that and we would use it to syndicate, and, you know, we did really well the other piece is I've always focused on being a real estate investor first and a money raiser second.
So the deals come first.
There's two ways to be in this business. Frankly, the smarter way to be in this business is to raise a bunch of money, to go right down the center of the path, which is raise money, charge fees, flip deals, get exit fees, rebuy, get people to reinvest and do this. It's terrible for the investor from a tax standpoint. Mm-hmm. And I've always raised money because I ran out of money to buy it myself. So I've always been trying to build my own portfolio. And so that's how I've always approached syndication. It's like, I'd buy this myself. I just don't have the money. And so most of my early syndications, I'm like, yeah, I'm putting in 30% because I just don't have the other 70. And it's like, well, as soon as you're doing that, then people are like, oh, wait a second. Like,
Yeah.
That's a different approach to things. Skin in the game, right? So, but through that, your original question about like how do you build relationships, like we did a good job. Like we would send out quarterly reports, so we had decent communication, especially for where technology was at that point in time. Now, of course, there's all this software, you can go bing and out it goes. But and we would so we got to the end, we'd have a conference call, and there'd be 50 people we invited, and there'd be another 50 people that would be their friends. I always call it golf foursome. There's one guy that makes the tee time, and the other three guys just show up. So if the one guy says he's doing it, the other three guys are just in because the other guy said he was doing it. And we get half the money. So we'd say, okay, this. And then, back then you sent a check. So we'd have the conference call, and you're like, I wonder, like, what's going to happen?
Yeah, are we going to get the
And then you'd open the mail the next day, and we'd get checks from, like, half the people we never even knew. And just like, so you got on that conference call, and you heard what we said, and, we thought we were smart and doing a good job and all that. But you're like, and then you just sent your money. You didn't even call and say, hey, like, I want to meet you. Interesting. So, the psychology around raising money is super interesting, but it's really about building trust with people and creating relationships, and that leads to referrals, and good things lead to good things, and so you have to be super careful about that. And then you got to go back to the first part: is if it's a really good investment, you'll raise the money. If it's not a really good investment, not only will you not raise the money, if you do raise the money, you've got a bigger problem, because now they're not going to do well, and here you go, right? So,
and you only have one reputation.
Yeah. It's like your virginity.
Once it goes, man, it's gone.
You only lose it once. You only lose it once.
I love that. Speaking of kind of these ingenuitive, different ways of thinking, which I know you as an investor and the way that you run your syndication is a little bit different than the average syndicator. Generational family wealth. From my understanding, that's how you look at these investments and how you raise money. Can you talk about how the way you structure your syndication is a little bit different than other typical syndicators?
Yeah, again, I told you, we don't go down the center of the fairway in the real estate business, because that's becomes really about raising money and making fees, and your percentage of the upside is like kind of secondary in a lot of ways. I've always been the investor first, looking for stuff for myself. So over time we developed stuff. We're doing like more traditional kind of syndications, that kind of stuff. Yeah, but the real secret to real estate is the tax advantage, and the tax advantage doubles the return in real estate over time. And that's why all family offices, as soon as they get a big pot of money, they run to real estate, even if they weren't in the real estate business before, because the tax advantages are unbelievable if you have the scale to be in the game.
And what are those tax advantages?
Most syndications don't take advantage of that. The big tax advantages, you can take depreciation to offset your income, so you can pay no tax on your current income. And then you hold the asset long enough, you depreciate it down. Your kids get the stepped up basis when they get it. So you skip paying tax on the asset forever, as well as you get a bunch of deductions against other income you might have outside of real estate or against other real estate. So if you set it up right, you don't ever pay taxes. And so, as we talked to our partners, we kept having the problem of like, oh, hey, we bought this thing. You gave us, most of the time when we were raising, it was people we knew. So we had a lot of 25, like we raised $5 million, 25 grand at a time on those phone calls. We'd have 50, 60 partners, because those were the people we knew, right?
Yeah.
That's what they had.
Yeah.
But anyways, if, use round numbers because it's easier. Okay, cool. You gave us 100. We did real well. In 2 years, we gave you back 2. And people would be like, oh man. And you'd be like, oh man, dude, like you gave me 100. I gave you back 2 in 2 years. Like, pretty fucking good, man. Why you like? You're
what else
kind of like, how about thank you, right? Yeah. Like, okay, well, what's the problem? Oh, you sold it on December 31st, and I wish you'd sold it on January 1st. And then the next phone call, but you sold it on January 1st, and I wish you sold it December 31st because I have this other tax issue, and now, the 100 that we made, now I have to pay taxes on it, and I depreciated some of the other piece, so I'm recapturing that. So the 100 that this extra 100 that you gave me, I'm paying 70 in tax because they'd already taken the depreciation and made the money before, and now I don't have anything to do with it. Now I got to find something else to do with it. And you're just like, whoa, okay. So you're upset. And like, well, don't you have a tax problem? And it's like, well, no, I don't have a tax problem because I have long-term real estate with the depreciation and so forth. So finally I said, well, why are we doing this? This isn't really benefiting our investors. Like the model of making the fees and the flips and getting your cash early, like matters. And as you're starting out, you need those as a syndicator to kind of live on. Mm-hmm. As you get a bigger portfolio and you can live off your own portfolio, then you can structure things differently. So now what we really do is help people take advantage of all the tax things. So we think tax first. you still have to make great real estate investments. But when you think tax first and real estate investment and great real estate investments, the combination doubles the return. You turn 10s into 20s, 15s into 30s. You don't have to try to make 30 to get an amazing return, because you can make 15 or 20 and get double that on the tax side. So, the cost segregation stuff that, it's a little bit more prominent in the knowledge base out there now, but, that certainly cost segregation's always been around. The accelerated depreciation that Trump put in place 4 or 5 years ago, of course, was a big, thing. And we were early adopters to that before you had a lot of people talking about that. But so we're really setting up for families. Mm-hmm. Will invest with us, but we're focused on raising the value, refinancing out the initial cash flow, giving you your initial cash back. You take all the tax benefits. We then split the profits above that. So most investors should get 100% of the money back first, and then 30 or 40% return on the tax savings that are generated from the depreciation of it. And then we split thereafter. We let them be in control, so they get to decide when to sell and when not to sell. And we're not in the business of flipping that asset, of saying, hey, it's been 3 years, let's sell it. Instead, we say, just hold it. Just wait 10 years. Being around long enough, you go, 2 years out of every 10, rents go up like 15 or 20%. And the other years, they float around a little bit. 1 year, maybe they go a little sideways, and 1 year, maybe they go slightly down. It's really hard to predict which are the 2 years where those rents are going to explode. And if you hold the asset for 10, though, you're going to get them. And that's where you get the big long-term returns. If you hold real estate for a long time, most people know it in their houses that they've held for a long time. And it's, oh, gee, we put down 20 grand and now it's worth $1 million and we made 600,000 on our 20 grand and or however the math works. Yeah. Right. So we're a believer in helping people own it long-term, refinance it, take the money out tax-free, and roll that into another property. So that's often what we're doing with people, is saying, hey, buy one, let's fix it. Let's buy value-add property. Let's fix it up. Let's get you we'll pull the cash back out. You get the cash. We didn't get anything, but now you have the cash, and you say, great, let's buy another one. So it works for us because we have multiple properties with you. It might take a little bit longer before we're getting paid, but generally when somebody gets the money back, they go, cool, let's buy another one.
Yeah, and then it keeps rolling, and then you build it, and you take the equity, and you're building equity over and over and over because you've done well for them.
Correct, and the taxes pay for it. So, in a lot of these cases, especially in the years where there's 100% depreciation, if you had somebody that had, significant tax stuff, you could buy an asset using high leverage. But if you bought the asset on hard money with the intent to fix it up and improve it, the tax deduction, the cash value of the tax deduction would be the same as the down payment. So you could legitimately say to somebody, we're going to buy this for $1 million. You're going to put up $150,000, but you're going to get a $400,000 deduction. That's going to save you $150,000 that you would have otherwise paid the government. And instead you bought a property. So the money was either gone forever, or you own this property, and no
brainer.
Yeah, exactly. Right. And, when you talk to people that don't understand that, you kind of go like, maybe this isn't a good partner, but yeah. So, the tax stuff has been phenomenal. The tax stuff is always good in real estate. It's of course been phenomenal with the Trump era stuff, but, there'll continue to be opportunities in tax stuff in real estate. And, so that's really our focus. Again, we have about 10 families that we're kind of doing that program with. Generally speaking, our answer is whatever you have to invest, put it into like 4 chunks that you're going to have or maybe have over time. So, if your unit's $250,000, great. And then by the time you get to the 4th investment, one of the first investments is refinancing and then funding the 5th. And now you have a funded business that's growing.
The flywheel's moving.
The flywheel's moving. Buy one a year. Don't listen to what everyone's saying. It's a good time. It's a bad time. It's a this. It's a that. Just buy one a year. There'll be a bad vintage every 10. If you hold it long enough, it'll work itself out. 2001, 2022 is not such the, amazing time to have bought stuff. Yeah. But even now, like the, rents are coming up and so forth. So it's tough for 3-4 years. If you hold it long enough, you'll be fine. Right. And then of course, when you hit the right vintage, it explodes. So
what today, how are you finding deals, and what does that process look like? Because I assume you're out there. I know you're out there looking at deals and trying to buy stuff. How are you coming across deals that you want to invest in?
Well, I try to have relationships with the most excellent brokers in the business, hence why I'm here.
Didn't pay him to say that.
No, but we've known each other for a while. You're a fantastic broker.
Thank you.
And you're a fantastic broker because you're straight up, You say what's really going on. You're trustworthy. You're not going to get, you're not going to say something that's not true. Lead front run someone, say, oh, if you do this, then that, that's not really true. Like, so many brokers step on themselves by just, slimy is the word that gets attributed to them, but they're just basically not being trustworthy and truthful. Mm-hmm. It's like people want to be around people who are trustworthy and truthful. You're certainly one of them. But we have 5 or 6 great broker relationships. We always do what we say we're going to do. That's our big piece. We, try not to retrade. LA is a big retrade market. We try to build our reputation on not retrading. Even when we get in something and you go, oh, this isn't right, we try to just walk away instead of retrade. The brokers, of course, well, tell me, what price would it work? And you're just like, my reputation's worth more than this deal. We're just not going to, play that. So
yeah, you always shoot me straight too on the initial offer, right? It's, I'm like, Kyle, this is a good deal. You're like, I'm at a 7, and I'm like, okay. And I know when you say that, that's what you're at. And so that means a lot to someone like myself who, when I have a deal that I want to sell or send it to someone who I know can perform and trust, like you clearly have built that reputation amongst the brokers that you work with pretty significantly. When it comes to retrades, you were talking about LA being a retrade market.
Yeah.
Tell me what you mean, just explaining to the people, like, what is LA's investor vibe?
Yeah, so we had an office in New York for a while and built some buildings in New York and had a lot of fun doing some real estate in New York, which is a whole different market that's, has all the things that you can attribute to New York, right? But
yeah.
So the difference, like in New York, the answer is you want to buy my building, go take a look, make me an offer. Your offer better come with 10%, non-refundable. Day one. You got, say, 50 days to close. That's it. Whatever our deal is, right? That's it.
Oh.
LA, I got 30 days to look at it and da-da-da. And, I found this out and I found this out. And then, the leverage is on the buyer's side because the seller really wants to close and not start all the way over. And you get to the end, but the buyer's not hard. And so, there's ample opportunity in the right situations to be like, oh, hey, well, I think he really wants to close. Tell him we need 10 grand, right? And, like you can usually hold people hostage effectively for some dollars because they're stuck there. The cost of starting over, the broker doesn't want to do it. Half the time the broker throws in the money just to make sure it happens, which isn't fair to the brokers either. That's another thing we never do is say, hey, don't put your money in the deal. We don't want you to be putting your money in the deal. The buyer and the seller have the money here. They can work it out. So again, we try to build that reputation so that when there is a good deal that needs to perform and is at the right price, we get a phone call because if it's a good deal that has that, there's ample people that'll pay that price. You got to be the one that has built a reputation of I'm going to close and I'm not going to mess around and I'm not going to get to the end and
I'm not going to take your fee. I'm not going to.
All those things that nobody wants. It's like it's tempting, right? But you don't want to do those things, or that we don't do those things. So we miss out on certain parts of deals because, the guy tied it up for $1 million and then he told the guy 800 and the guy said yes. It's like, we would have paid 9, but like, but
yeah, your reputation and everything like that, it's not worth chancing that off of the seller actually capitulating. And then also the broker probably doesn't like that buyer very much anymore because he makes his seller look bad and the seller's mad at him and it just becomes not great. Why do you think that what the process is in New York? Why do you think we don't do that in Los Angeles? Culture?
Yeah, I think it's a little.
Should I start doing that? Is it better for the? Is it better?
Like it's great because it's a big boys game.
Yeah,
right? So you chase out of the market. It has all kinds of different pros and cons, but the interesting part is you have to be a big boy. You have to, if you're going to put up 10% hard, like the very first deal we did there, we're borrowing all the money to put up $100,000 to say that we can call around some people and raise 700 and we're not going to get the 100 back that we borrowed from friends to do it. Like, it's a stressful thing to get into that game. And it's not, we're here, you tie it up. Oh, we couldn't find the money. We'll just get our deposit back. We'll walk away. We'll blame blame some reason. Mm-hmm. So, it chases away a lot of the smaller investors because you really got to be a big boy and you got to know what you're doing. It's nice from the broker's side.
Yeah, it is. That would be nice. I didn't even think about that. I mean, I love when a non-contingent offer comes in. Don't get me wrong, but I didn't even know that was the standard in New York City, which is interesting to me. But it makes sense. I mean, those are bigger buildings too. rare that you find a $1 million property. And
no, for sure. There's a
mom and pop LA is all small mom and pops anyways. It's the land of small 8-unit, 12-unit properties.
Totally. And there's places in New York where it probably plays a little bit the other way, where some of the small properties are in the outlying boroughs and so forth. But if you're playing in Manhattan for sure, and even Brooklyn and those types, you're playing that kind of game. So we're trying to get to we've been, as a good real estate investor, you never have any cash because as soon as you have some cash, you're like, oh, that's a good one, let's buy that one. But we've been working hard to get to a place where we've got cash and can close quickly, so that in certain of these situations we can say and actually perform on, like, we'll go hard and close in 10 days. And, you see some of those people out there, and I think you do end up driving, get a little bit of savings or win some deals that you might not win otherwise because of the terms are as you can imagine. So
tell me about, we were talking about this new product that you guys are coming up with where it's a partnership JV situation. And I had told you when we were talking about this that I had this idea 2 years ago, and I thought it made so much sense because there's so many landlords in Los Angeles that just don't run their building to the maximum effect they could be, while also having the relationship with the tenants. They're very lenient on that. So tell me about this new product that you're kind of ideating on and trying to figure out.
Yeah, so we're working with a couple families on it. Like, it's interesting over time. When we were younger, somebody'd say, "Oh, I know somebody's in real estate. Maybe he'll invest with you." And it's like, no, he's buying his own buildings. He's not going to give us the money to invest. He's doing his own thing, right? Well, over time, we get, it's part of it's my age too, but like now I'm meeting more people that are, at the later part of their portfolio accumulation, whatever, they're probably in their 60s, 70s, 80s, been great real estate investors and so forth, but, they've got a foot off the pedal and so forth, and they're not asset managing to the level and so forth, and maybe the kids are interested in the business or not. We've always bought these buildings in these situations where they've been mismanaged. And
I'll buy it from you, sure.
Yeah. And then, it kind of came to us like, well, okay, more and more of these people are like, I've done all the work. I don't want to do the work anymore. But my family, we bought this building put the kids through college. This building is the golden goose that keeps on giving. I want my family to have it. Maybe the kids see some of that. Sometimes they want the money really fast, but, see some of that of like, hey, we want to have real estate in our portfolio, but we don't want to deal with it anymore is always the answer. I'm selling it because I don't want to deal with it anymore. Well, same things as you buy stocks. You'd either buy a mutual fund or you'd hire a broker that would charge you something to go pick the stocks and help you manage it. And for us, it's like, okay, well, we don't have to go find the assets. We don't have to go raise the money. We just need to work with these people and say, hey, okay, if they're worth this today, if we can make them worth more, we want to participate in making them worth more. And usually it's incredibly obvious, like you say, that, oh, I just didn't raise the rents because I didn't know, I didn't get around to it. And it's just not professionally managed, right? So it's pretty easy in these situations. And then you see these guys like, hey, we can help you, turn it from $1 million to $1.5 million really fast. Like, you've bought it, you've held on to it. Like, why sell it to me for $1 million and I'm going to turn it into $1.5 million when you could do that, right? And so we've been working with a couple of, like I say, families that have a portfolio that in some situations, and the general concept is you'll hire us for a while. Usually, by the way, my kid worked for me this summer, and he said the same thing. Dad, why you have this and that, and we have all this random stuff, and like these are terrible. And it's like, okay, kid, but the taking that portfolio and getting into something for the next generation to manage. So it might be selling off it might be fixing a few assets and selling them, trading them into something else. Deciding, hey, let's get rid of this in the portfolio, but let's keep these. Let's move into higher quality assets that maybe have a different return profile. Of course, the triple net world is obviously the easy one. But if you get into really high quality multifamily kind of stuff, you might have some of those characteristics. And again, if you have, we call ourselves the real estate bodyguards. Like, we're here to implement what you want to do. We will give you all the advice of what we suggest doing, but it's still your properties, ultimately your decisions and your control.
And so you make money through the upside that you create. So you have to first determine with them, okay, your property today is worth $1 million. We think we can get it to $1.5 million. We're going to share in a percentage of that upside, which then gets paid out how? Or is that the structure?
Yeah, so that's the structure. We would basically get paid out at the end of the relationship, right? So
either refinance.
So if there was a refinance, if there's cash flow that got distributed, those pieces. So again, we'd just have a baseline. They would get things to that baseline, and the dollars above that we would share in it on a percentage basis going forward. So for us, it's a long game of like, hey, we can turn these into stuff. We're happy to sit around and hold them with you for a long time. We're also happy at any point you say, hey, we want out of this. Generally speaking, we're trying to keep things super simple of saying, all right, we're going to take a rent multiple, we're going to take a cap rate, we're going to take something to value it today, and then we're going to take the same thing to value it when you decide that you don't want us in these deals anymore. So the market might move up or down, and maybe that helps those, they obviously have the decision of when to do it. So they have some potential for multiple accretion. We're like, okay, whatever. Generally speaking, you look at these and you're like, these are so easy to make a bunch more money for them. They're going to be happy. But let's make sure that the breakups are simple. All my partnership agreements, I look for the simplest sort of breakups. Generally speaking, I like I've heard it, usually it's termed the Chinese wall of stuff. If we're partners and somebody says, oh, I want out of this partnership, one guy names the price, the other guy says if I'm a buyer or seller. So if you name the price too high, then the other guy's going to force you to buy it. And if you name the price too low, then they're going to buy it. But it's a real fair way of calling everybody on the carpet, right? And real
I like
quick,
that.
We don't have to get 3 appraisals that somebody paid the guy to make him a fake bullshit appraisal, and then lawyers and this and that, and have all this acrimony. It's like really,
the Chinese wall. That's a good one.
It's really man up, right? Like,
yeah,
okay, I say it's worth 1 too. Okay, cool, buy it. Like, and can be quick and easy. So I always think in partnerships you want easy ways out.
Totally.
And that also keeps, when those are the situations, it keeps everybody honest. It's like, well, I'm not going to be such a jerk in this partnership, because at any one time you could say, okay, let's end it, and we can end it really quick and easy. I think so. Anyhow, thoughts on that?
I like that. That's very interesting. And I think with Los Angeles, I've underwritten thousands of properties, and it is prevalent everywhere. There's many mismanaged and undermanaged assets that could use something like this. And it almost is accretive to the model of you wanting to build like family office wealth anyways. So you're almost consulting with them, improving it. They're sitting back and you're doing all the work, and it's like a win-win scenario, which makes a ton of sense for my understanding.
Yeah. I think again, when you're raising money, if you focus on like, well, what's your problem or your situation? Or like when we go talk to family
You're problem
offices,
solving.
We're trying to be more of a problem solving than like, hey, I have this deal. This is a good deal. Do you want to be in my deal? It's like, well, wait a second. What's a good deal for you? What are you looking to do? What kind of assets are you looking to buy? We can go find the right kinds of assets if you know what you're doing, of course, and, the brokered network, as you know. But it's very different. Do you want, West LA multifamily, or do you want East LA multifamily? Very different kind of products. They both have characteristics that have pros and cons to them. But what are we trying to do? So if you start with, what are you trying to do? What are you trying to build over time? What cash flows are you trying to look for you and your family and so forth? Then you can back into like, okay, well, this is the real estate that makes sense, and this is the tax situation that makes sense for you. How do we maximize the tax? Find the right real estate that's going to fit for that piece to it. So, we do a lot of that. At the same time, a lot of our families are like, no, we want the most, opportunistic deals. I'm like, as you know, we're looking for opportunistic deals at all times. And okay, cool. If you want to follow us on what we think is most opportunistic and we think you can make the most money on this, great. But at the same time, we're here to solve your problem of what you need. And, again, half these families, the problem is we have all these assets. We don't want to manage them. We don't necessarily want to sell it and buy stock and pay taxes, but we just don't want to manage this anymore. The hard part, of course, is they've got to agree that, we're going to give up some of the upside, and, getting someone to appreciate that we can actually make it worth more than they can. That it takes a certain person and a certain level of experience to be like, somebody can do this better than I can do, right? Most humans don't want to admit that somebody else could do it better than they could. You tend to find that actually with the guys that have been doing it for a long time. It's like, well, I could do it. Then the answer becomes, I could do this as well as you could if I wanted to still do that. And if I was going to spend the time, but I want to spend the time with my grandkids. It's like, makes sense. You've earned the right. Like,
yeah, let us go and do that. And if you want to be on board, we'll go make it happen. Here's all the examples and track record that we have to prove it.
Yeah. So again, it kind of came out of like I said, the original investment of moving from syndicating to whole ownership with people was, hey, this is a better tax situation for our investors. Is it a better structure for us? Like, maybe yes, maybe no, but it's certainly better for the investor. So follow that
if you get
piece.
scale, then
it for sure. And then we found a way to make it really good for us with the scale and the repurchasing and so forth. Again, here's another product that's like, oh, we've got a good relationship. You're good people. We'd like to do something together. But what's your problem? Not like, hey, can you give us some money to go buy something else? It's like they already have stuff, right? So again, focus. And when you're raising money and you're talking to people, if you focus on helping them and finding a way that you can make money on that situation, quote, the win-win, right? So
totally. What is the best deal that you've ever done?
We've done some random ones. So the story that I love on the best deal that we've ever done. So in New York, there's a thing called the High Line, which is kind of well known at this point, but it was an old train track from the 20s. The city was originally going to tear it down. There was a big movement to save it, turn it into a walking park. That's been done. We had some assets on it. At one point, we were big donors to keeping it and highly involved in that. And so we were looking at assets in and along the High Line because we knew it was going to become a park and people walking on it. So the assets next to it were going to be great. So we identified this parcel that was about 4,000 square feet that was literally under the train track. So it was literally under the train track, bums there, dripping with like water and this and that. But in New York, it's 4,000 feet. It's worth something. It also had air rights as a thing in New York where you can, because of that, you can build them and then they allow you to transfer them. So they have value. So I can sell somebody the air right to build 1 square foot. They can build that 1 square foot somewhere else. So at that point in time, the air rights were worth like $300-400 a foot, right? So we find this piece that like somebody owned that it's literally bums sleeping under the train track. And I think I'd have to get the exact numbers right, but more or less we agreed to buy it for $4 million. And you're like, we're going to pay $4 million for like this thing under the train tracks. And from an LA perspective, like you shake your head, right? And you're like, yeah, okay, that makes sense. And it came with 4,000 feet of air rights. So we're like, okay, wait a second, we can sell the 4,000 feet of air rights for $300 a foot. So we can sell those for $1.2 million. So we put it in escrow, went hard, put it in escrow. We found somebody we knew somebody to buy the air rights. So we signed a contract to sell the air rights at the closing.
Wow. So you already had that lined up.
So we were selling $1.2 million of air rights. We were going to keep the property. We had a bank that was going to lend us against the property. And they lend us, we needed $700 down. So at closing, we got a check for $500,000 because we sold the air rights for 1.2 and we had to put down $700. That bank then went through got taken over by the government in the 2008 crisis. The new lender said, we got this loan on this dirt under a train track. We don't want anything to do with this. So, we had borrowed like 3.3 on that $4 million purchase. And so then they said, whatever, we want out of this. We'll sell you the 3.3 loan for $1.5 million. So then we bought the 3.3 loan for $1.5 million. Financed that with like 1.6. So we paid for all the fees and we walked away with like, enough money to go to dinner, but we didn't have to do anything there. And then we reduced our debt to 1.6. And then we turned around and sold the parcel under the train tracks for like $3 million and made like another 1.4. So we never put any money up. It was this random piece that like you kind of laugh at. So
shuffling a bunch of paper
so that was kind of a fun one because you're like, what are we doing buying something under the train track? And they've since built an art gallery building under the train track. Is very artistic over on 10th and 24th.
Wow.
It was ended up being a cool development, and the High Line of course happened. It's a great addition to New York. So
High Line's sweet.
So a bunch of sweet stuff happened, but it was kind of a fun one because we made a bunch of money on a kind of weird one.
That is incredible. Those are the stories that I love to hear. And when I do hear them from investors, I'm like, how did you, that's the power of real estate. That's the creativity. And it's still one of those industries where there's information asymmetry. Like there's insider trading. It's real. It exists. If you know something that someone else doesn't, or you can see something a different way and have a vision that others don't, that is, to me, the secret sauce of what makes really good operators and owners good. It's because they can see that. They have something else that other people are missing. And you've obviously you guys have found that little skill in whatever it is that you're doing.
We work on it. You got to be, everyone says, oh, you must have been super lucky to be there. I'm like, well, if getting up, at 6 a.m. and looking online and finding the thing and being the first one there means you're super lucky, then yeah.
Exactly. I know.
As you know, you got to work hard to do it. You got to have hard work to do it.
Yeah.
Too. But you're totally right of the 20-year
overnight success.
Yeah, exactly. And
what, so speaking of overnight success, Manhattan Beach has been your home for, it seems like 20 years, something like that.
Yeah, the number's probably bigger than that. It might be 30. I drove straight from college graduation to my apartment in Manhattan Beach, so that's getting back a few years.
Yeah, we'll say it's 20.
Yeah.
But Manhattan Beach, when I first moved to LA, I moved to Manhattan Beach, Redondo Beach, but close enough to Manhattan Beach. It's one of my favorite places in Los Angeles. I think it's a little slept on compared to other neighborhoods. The best beaches in SoCal and LA, and again, my opinion, but I think that's a true fact. You own a bunch of real estate in Manhattan Beach, and I think you've seen it since when you've bought, and the appreciation and the wealth that has grown in that neighborhood. It's a very wealthy neighborhood. Like, how did Manhattan Beach happen, and why, besides just proximity, did you have some vision of what Manhattan Beach could be? Or was this kind of like, oh, I'm close by, I like the real estate, I'm like, yeah, we'll buy it?
Well, so Manhattan Beach changed. I moved there in 94, so somebody can do the math if they want to. But the big thing that happened in 94 is the 105 freeway got put in, and that changed so you could live in Manhattan Beach and work in downtown, where before you'd have to take surface streets to get to the 110. It was about an hour and a half. It turned that drive commute into about 45. So that brought a bunch of wealth. The school system, they've done a really good job, MBMF, raising money and getting the school system better. So now you had a next influx of people from the west side saying, hey, I've got to pay $40,000 a kid for school. If I move to Manhattan Beach, I save that. I put them in school there. I save $80,000. I'll buy a nicer house. So that drove wealth in Manhattan Beach. But, it's always been a nice high-end coastal market with expensive real estate. I messed around looking there. It took me 20 years before I bought anything commercial in Manhattan Beach to finally find a deal that had an opportunity. I'm always looking for a deal that we can buy, and in 2 years later, we can make it worth enough that we can refinance and get our initial money out so that we can go buy something else, which started, everyone's like, well, how'd you come up with that formula? I'm like, well, I had to, because if I didn't get my money back, I couldn't buy anything else myself. I didn't start with these, as many relationships. I didn't have the uncle and the family friends that were, cashed up to invest with. So, our journey is a little bit different than others, but, so there's various points in Manhattan Beach where you've been able to find some opportunities of, buying something and having the value add situation be there. And then, as you know, now we've there's also one sale a year in the commercial in Manhattan Beach.
Yeah.
So it's a little bit more of a hobby than a business.
Mm-hmm.
But we're involved in, about half of them, generally speaking.
So how many buildings do you have in Manhattan Beach?
I think it's 9 or 10 at this point.
And mostly on Manhattan Ave?
The Manhattan Beach Boulevard.
Manhattan Beach Boulevard.
Yeah, mostly on Manhattan Beach Boulevard. The Boulevard is the higher value, the higher dollar place in Manhattan Beach. So
retail, right? Yeah. Retail, office.
Retail and office upstairs. So our business model is, generally speaking, trying to have very high-end office, rehab the building so you have very high-end office up above, because the clientele that's there is very interested in a high-end office that's near the beach and all that. They're not interested in there's less demand. There's still demand, but that client that is willing to pay anything for that office is not willing to go into the one that's sort of the old beach shack. Mm-hmm. There's still plenty of people that love the old beach shacks, as I do, but the business model has been generally to upgrade the office space and then rent the retail down below.
Well, and Manhattan Beach, people are like, office, why would you buy office? It's not like the standard office towers. This is beautiful retail at the bottom, really nice coffee, breakfast spots, whatever, and then it's like your private suite, penthouse office, little, this is where the wealth managers go and the lawyers and that kind of stuff. So
yeah, they're two-story. It's a beautiful office away from the home, but close enough to the home.
I'm going to the office, and they take their bike and they, or walk.
You got Simsies downstairs, and you meet your buddies downstairs for beers out the top and so forth. So
yeah,
it's a very fun community to have your office down there and so forth. So yeah, we're actually in escrow right now on an office building down there, and trying to find financing for right now for an office. Like, you talk to banks, like large banks like Chase will say, oh, we don't lend in any office. You're like, any office? Like, does it matter? Like, no office. Like, anywhere in the country, no office, right? And I'm sure they do some very big deals for some people somewhere else, but like at a small regional level, their answer is no office. Like, and so the lenders kind of run like sheep like that, though. So, 3 years ago, we had the same conversations. They wouldn't lend to us because it was retail. It's like, well, it's mixed use, it's retail and office. Oh, we can't lend on anything that's retail. Okay, great. And now we've got the opposite. Oh, we can't lend on anything that's office. It's like, well, it's mixed use. It's retail downstairs and it's office upstairs. And it's not really office as you think of office, but,
they just make this blanket statement.
Yeah, so there's funny things that happen in the real estate.
I heard a rumor.
But those are the opportunities, right?
100%. I heard a rumor, and you can tell me if this is true or you can deny it. I heard there's an Erewhon going in Manhattan Beach. Is that true?
I have heard that. I have not heard that from Erewhon or the property owner, but I'm pretty sure that that's true somewhere on Rosecrans.
Yeah, that's gonna be crazy. I think it's in the Mother's Market, is what.
That is the rumor that I've heard. That might be across the street from both of our offices.
Yeah, I know. Jeez. Well, my former office, man.
Yeah, former office.
Honestly, it's probably better for my wallet, to be honest with you, because I would run out of money if I lived across the street from Erewhon, which, if people don't know, it's the most expensive, fanciest, really delicious grocery store in Los Angeles. So it's funny because I worked with a couple of retail guys who you've worked with too, and I felt like newer and better and unique. Kind of the retail space became really hot. It was very mom and poppy for a long time in Manhattan Beach.
Yeah, and
Salt and Straw, you guys brought in. Erewhon's coming in now, but there's a lot of these more, I would say, not corporate, but just higher end, kind of retailers.
Yeah, I think retail and high street retail is certainly moving that direction. It's hard to be in the retail business if you're not.
It's like $10 a foot.
Yeah, $10-12 a foot is kind of boulevard rents,
which is not bad, because I was just on Rodeo Drive, and Rodeo Drive, or maybe Beverly Drive. Anyways, one of them was asking $20 a foot for retail, and so if you think about it, Gucci, Prada, whatever's $20 a foot, and most likely 18 you could negotiate it down to.
Yeah.
Manhattan's 10 to 12. It's like, wow, okay, we're kind of getting somewhere. So if anyone visits Los Angeles, Manhattan Beach is definitely a place where I think you need to go, and go into Kyle's buildings that has the stores in them, and support the local community. Yeah. Before we wrap up, I want to ask you about really what's next, and over the next 5, 10, 15, 20 years, like, where do you see yourself, or in an ideal state, where do you see yourself, and what does the business, the company, your time, what does that look like?
Yeah, so, I'm getting to the place where you're like, somebody said to me, we were in escrow on something, and I was saying, oh, this is happening, and the bank didn't, somebody didn't do this, and like, as you know, closing a deal is just a whole experience of everybody not doing their job, and like, you said you were going to do this, and you didn't do it. Like, no one does what they say they're going to do anymore, right? And so I was all frustrated, and the person goes like, well, you said you have like 79 apartment buildings. I'm like, yeah, something like that. He's like, why do you need 80? Like, I was like, that's really interesting. I don't know. Like, the hamster's on the wheel and the mouse likes to find the cheese. Like, I don't really have an answer. So it did make me kind of step back a little bit and think. So my focus right now is bringing in some younger people to build the business really as something that can move forward without me and get myself to where I'm a little bit more the limited. So, we're bringing in a CFO. We're going to bring in someone on the investor management side of things, and we now have like 700-800 units and so we're trying to revamp the property management company. Has to run different with that kind of units than it did with half those units. You keep having to reinvent the methods in which you run things. So, for the first time, I'm trying to focus myself on the actual operations of things. I always love the go growth and go do the deals, and I'm kind of a deal junkie, as you well know. Mm-hmm. So every email I get, maybe, but I'm trying to get a little bit more measured in what we're doing and build something that has some sustainability, and back to some of the original comments of it being a job shop, of like not having every answer and piece need to come for me to my approval. And so really have a really high quality team. And we have a really great team, and the people that have helped us get here are fantastic and committed and so forth. So it's, but augmenting that and making sure that that's set up well for the future.
You're still going to answer my emails, right?
Yeah, no, I can't kind of help myself. So then when you go do that, you go like, oh, well, if we're going to do that, we have to go from 700 units to 1,000 units. Like, okay, well, we better go back, right?
Yeah,
so,
I know.
yeah.
I know. Well, I'm glad I'm still gonna have direct communication, and this is no time soon. I know it's we're deal junkies. We love deals, and it's hard to take that out of people, right? It's like you can delegate as much as you want, but there's just certain aspects of business. It's not about the money. It's about the deal. It's about the process of it. And so I don't think it's a bad thing necessarily for you to continue to want to enjoy that aspect of real estate, but delegating some of the stuff that maybe drains you.
Yeah.
I think we all think about that every time. It's like, I don't really want to have to do this. So you can do
I
that.
think that's right. And I think the companies that are set up best, the principal is close to every deal just from all the things that go on. Like the broker needs to know. It's like, you can't, I've had an acquisitions person in the past. There's all kinds of, it's just another broker. Your own employee is a broker to you, and usually they're on commission. So they're trying to convince you to buy it even when maybe you shouldn't. Like, and then the real broker is like, well, I'm not even talking to the decision maker. So this is a waste of my phone call. Like, when are you going to talk to Kyle and then call me back and blah, blah, blah. It doesn't work really well. And so your relationships with the brokers suffer internally. I'm not sure you end up with the best deals, et cetera. So, again, my hope is we get to hang out, and I'm going to stay close to the deals.
Absolutely. Much more. Kyle, I appreciate it very much.
Yeah.
For you coming on here, dude. Thank you.
Well, thank you, and future success to you.
Absolutely. We're going to keep growing it. We're going to do a deal here. We might be doing one right now. Who knows? Thank you, guys.
Cheers.
Dude, I love it. Thank you for listening to this episode. If you enjoyed the podcast, it would mean the world to me if you could rate us 5 stars on YouTube, Spotify, and Apple Podcasts. It really helps us get our name out there and helps us get fantastic people like our guests to share their insights and knowledge with you. Again, my name is Taylor Avakian. I specialize in the sale of apartment buildings in Los Angeles and Southern California, and I look forward to sharing more of these conversations with you. See you in the next one.